Discover how alternative investments can diversify your family office's portfolio with uncorrelated returns as we explore a purpose-driven approach to solving global challenges. Today's podcast unlocks actionable strategies for balancing profit, impact, and resilience in today's volatile markets with my guest, Nishad Parmar, managing partner of Loud Capital. Nishad, hey man, welcome to the podcast, dude.
Thanks, Tommy. Thanks for having me.
Yeah, dude, let's rock and roll. So I always ask this kind of question of all my guests. How did you get into what you're doing? Like, you don't go to college to be allocator of funds and capital and these LPs and GPs. What got you into this business?
Yeah, so I started off in a completely different industry and background. So my background's in computer and electrical engineering. It has nothing to do with finance or venture or private credit. Spent about 22 plus years in the public markets, working for like heavy industrial companies, manufacturing, defense, clean water, clean tech. These are companies ranging from 2 to 3 billion all the way up to 45, 50 billion, all reporting publicly to on our stock markets and in various roles from supply chain, operations, engineering to commercial strategy, growth, M&A, and I had a great career. Learned a lot from the public side of the market, reporting up to the street, to the board, and really how things happen on a quarterly basis when you are a publicly traded company. And then I was kind of doing my MBA at Kellogg, and I was like, man, I'm done with the public markets. Loved it, enjoyed it. I want to go private, so started doing some real estate investing here in my own development in Chicago. Started a couple of e-commerce companies, sold off one, and then really found who my partners are at Loud. We kind of connected back in 2015 is when the firm started, really exploring, getting into the private markets, alternatives. And we were getting into venture at the time, and we'll talk more about what we do now at Loud, but that's how I got into it. And my other partners are based out of Columbus. I'm here in Chicago, and we connected, we hit it off, and that's how everything kind of started off in 2015. And I left my corporate job as an executive, and then really took the leap of faith and kicking off our new firm. And that's kind of where we landed off with Loud.
Yeah, cool stuff. So it's interesting. I was doing some research on Loud, and you guys have this tagline, "Venture for People." Like, tell us that ethos. What is it that drives you guys and how you guys look at the market?
Yeah, so as we first started off as an early stage venture firm, and then we've evolved into an alternative investment firm now since we started. We're like our 10th year in now. We have a little bit of grease under our belt, have a good amount of traction, performance to show. We've gone through a little bit of ups and downs, especially with COVID being in the middle of our life cycle. So we can say we experienced some type of black swan event to show that. But as we were first starting off, it was like, we have a tagline, venture for people, profit with a purpose, just like a purpose around it. So if I just think a couple of taglines, venture, or call it alternatives for people now, since we've expanded beyond venture, is it used to be an exclusive way. There's two sides of this spectrum. One is the investor side or LP side, and the people who are kind of like really doing the deals, getting into the deals. And the other side is the entrepreneurs themselves. So there's on the LP side, it was a high minimum to get in. Some of these funds, some of these exclusive funds are hard to get into. You have to have a high check size amount to get in, and you don't know who the players are to get into really good top performing funds. It's like, hey, let's make this for all people. Let everybody come in. Let's drop our minimums. Let's allow people to get comfortable and get access to alternatives that they can add to their portfolio. And then the second part of that is the entrepreneurs themselves, or the people that we're funding, whether it be on the early stage side or even the private credit side. There's a lot of people that can't get funding, right? Their access to funding, they don't know where to go. There's a lot of demographics and metrics around people not getting access to this funding, whether it be in a specific region, a different type of demographics of a founder or an entrepreneur, or even like a business owner, because we fund also small, medium cash flowing businesses around the US as well on the private credit side. So that's how we started off, is really making it alternatives for people and all people, and allowing both spectrums of that to open up the floodgates of capital coming in, and then also capital being deployed out to these companies that we can fund and generate healthy returns back to our investors.
Well, that's great to hear. So yeah, so 10 years kind of in, right? And you had this mantra of helping people, and like, what's the impact been on the entrepreneur side? Like, I know, go a little deeper on that, like, where when we say some individuals can't get traditional financing or don't know, is it just not understanding what's out there and available to them in the traditional sense, and they then look at the private side? Like, what is that journey for someone that's looking to raise capital who just doesn't understand what that looks like outside the traditional banking model, let's say?
Yeah. So I would look at two things. One is the equity raise, and the other one is call it debt financing or some kind of private credit financing. And we play in both spectrums of that. So if I look at the equity side, there's a lot of companies that cannot get funding. The Midwest in general, right? A lot of the money mostly stays in the West Coast and the East Coast for the venture side, right? Whether it be early stage or even late stage venture. Midwest is a great pocket. The value of the funders, the value of people that are here, just the Midwest value, right? It has some type of earth to that ground, like how people operate here. The value of the company itself, from an intrinsic value, is also very fruitful, very good to get in on a deal in the Midwest versus some maybe higher multiple deals, higher valuation deals on the East Coast and West Coast. A lot of women don't get funded, so on our venture side, we're on our fourth venture fund. That's going to be healthcare focused. About 40% of our companies have been women or minority owned companies that we funded. It naturally happened. It wasn't originally in our first kind of, oh, we're going to start off with this on paper, but it's naturally we found that these companies just weren't getting funding. They're great companies, great value, great product or service, great concept, and a great team that we can come and fund and help grow. On the credit side, you think about the non-banking side, there's a huge market. We have about 34 million small, medium businesses in the United States. They are almost a backbone of our economy. I was just recently reading, I think 60% of employment is covered by all these small, medium businesses of private companies that employ people. So they are truly the backbone of the economy in terms of employment, consumer product, kind of spend, and a lot of that side. And a lot of them can't get funding. The banks take too long to fund. They might not meet the bank's box of their criteria, and they're just a little bit outside. The banks are very black and white. Oh, you're not going to make it. And they're looking for funding for equipment financing, expansion, M&A, whatever that may be. And they're coming to the private side, right? They're looking for our type of capital, flexible capital besides equity, because these are family-owned kind of private businesses that have been around for a while, that they need this capital to help them grow their business, and they can't go to a bank to do that. And that's where this private credit market, which is getting a lot of visibility, there's a lot of noise, a lot of activity around the private credit market. It's grown significantly over the last several years.
Yeah, so when you look at, again, staying on the entrepreneur side, right? Because this is a fascinating component to the LP and entrepreneur side of this equation. So when do they understand the difference between equity and debt, right? If you think about it, it's from the investor standpoint, it's a line item, it's an investment in, right? Or a note due or receivable. Do they understand the one is non-dilutive, one is dilutive? Is that an education for a lot of these entrepreneurs?
No, I think the entrepreneurs, when call it the point where we come in is close to that Series A level, that they've done their proof of concept, they have a product, they have some revenue, some customers now, that they understand that between, call it either venture debt or private credit, but the companies we're funding at that level are truly equity companies that we want to fund. They don't have the revenues to cover the debt cycle or the debt payments, right? So there's two different completely spectrums on this side as well. You have the entrepreneurial side. These are truly venture companies with concepts and ideas and business models that can scale at a very exponential level. Then you have the other opposite, which is, call it the small medium business, non-venture, not sexy, not this amazing SaaS product or some kind of technology. They are like HVAC, plumbing, construction, logistics, like other types of steady businesses that have been around for decades that are looking for capital. And they understand that side where they're not looking to give up equity, but they want to get some type of debt financing, some kind of, some kind of unique line of credit tied to their assets, versus the venture side is they understand that they need money and they have to give up their equity for getting the right strategic partner in next to them to help them grow over the next 3 to 5 years.
Yeah. And so let's flip over to the LP side, right? The investor. like what are they looking for in terms of alternative investments? Obviously, there's this uncorrelated um, thesis of why have all your eggs in one basket, right? Why be in public securities and markets when you can get into real estate and alternatives? So help people just on a high level understand like what does alternatives do to someone's asset allocation?
Yeah, so it used to be that boring 60-40 split, right? The bond market, and then you have the equities market. And if you think about how someone does a public equity investment, whether it be a family office, a high net worth individual, even a large family office, they're still going to maintain, okay, I'm going to do some fixed income bonds, CDs, low risk, some medium risk, some mutual funds, some ETFs, and then some high risk, some speculative stocks, some dividend paying stocks. And they have a nice balanced portfolio. And they have their own team, or they have an outside team managing their money, whether it be a large family if they can handle it themselves internally, if they're large enough to have a group, or they have a multifamily office and they're managing that. And that's what our concept was like. As you get into alternatives, why can't you do the same high, medium, low from a time horizon, from a liquidity standpoint, from a dividend paying perspective, from a tax strategy, and look at that same diversification in the alternative market, right? So the first thing that people go into is real estate. They can touch it, they can feel it. Most of the family offices and high net worth want to go into real estate because they feel comfortable, right? That's only one portion of the alternative market. The alternative market's around 15 to 17 trillion dollars now, and it's going to probably double in the next 5 to 7 years. Real estate is one component, right? Hedge funds, private equity, venture capital, private credit. Private credit's probably about 1.5 to 1.7 trillion dollars just in the United States. I'll probably include Canada in that too, which is a small portion of that 1.7 trillion. Even though I am Canadian, so
Yeah.
but a lot of activity happens in the United States in terms of just the capital movement. So there's a huge bucket of alternatives that people can access. So we play in everything but real estate. So if you think about from an LP's perspective, back in the day it was maximizing returns, growth equity, doing some ventures, a lot of public markets. Didn't really focus too much on downside protection. It was like really just focus on high growth, finding those alphas. And now it's capital preservation. That strategy has changed now is what we're seeing from these family offices. Income stability, really setting that up as a lot of generational wealth is going to be transferred right now from these families into the next generation. And they might become the largest, call it capital holders of the next generation, of this private shift of happening from one generation to another for these family offices. That the next generation, the capital markets in the family office space is going to be tremendously high in terms of cash and ability to go and invest and really do some major movement of capital deployment. So they're looking for that diversification beyond public markets, right? The private credit has gotten a lot of visibility beyond real estate, a lot of non-correlated cash flowing type deals that our investors are looking for, and some flexibility, right? So what we're noticing is they're looking for shorter term investments, anything 5 years or less. They're looking for shorter lockups, co-investment rights, a lot of transparency. They like to see transparency in terms of how we report things. Nowadays with data, systems, and it's just technology, just the back end of AI, using other platforms to do machine learning, ability to really take massive sets of data from an investment standpoint and really provide good, transparent reporting and tracking is really huge for these families. And they want to see stuff weekly. First, we used to do things quarterly. We're moving to now monthly, even to weekly reporting out because we're so fast paced on some of the things that we're doing. So that's kind
Is
of
that,
what we're
is that
seeing around the LP side.
yeah, does that like that high frequency of reporting make it challenging to have these longer plays play out because now people are looking at that weekly or even monthly report saying, all right, we need to shift, we need to pivot. Like is that causing some issues within the industry?
So it depends on the investment strategy. So if you look at venture, a
Hmm.
little more longer term, 7 to 10 year time horizon, that is more quarterly or more semi-annual, a little more longer term because there is some growth strategy in terms of how we're going to really take these companies and help them grow 3, 4, 5x, 7x. On the private credit side, it is much more fast paced. We are investing in about 4 to 5 companies a day. So we see about 150, 170 companies in our pipeline that come through a daily. Out of that, half of them don't meet our box. the ones that do, we go through a full underwriting scrub process, and we'll talk more about kind of like the investment strategy and what we focus on. But then when we get down to that funding opportunity, it ends up being 3 to 5 companies a day that we're funding. So if we're doing, call it 15, 20 companies a week, there's so much changing, right? There's new companies are coming in, different industries, different states, different type of sectors that we're focused on. So we can provide a weekly type cadence in that strategy because it's just more fast paced. So I think it just depends on the strategy. And they're two different in terms of how we operate. We have the venture side and the private credit side, completely like a 180 between how the model works and the return profile as well.
So those are okay. So you're not doing performance reporting at a weekly basis. You're doing here's the deal flow because you're funding so many so quickly. Is that correct?
No, we're doing performance reporting as well.
Wow.
We are looking at our data. Remember, if we funded a company this week, we funded 20, 40 companies the last 2 weeks. So what's been going on with those companies as you come into week 3? As you go into week 4, now it's 60 companies. You go into week 5, now it's 80 companies, right?
Wow.
Now we fund about anywhere between 500 to 700 companies a year. So it's very
Is
fast
that,
paced and it's growing. We're
that
growing at a very, significant pace, which is great. We've had great support from our LPs and our pipeline's looking strong and our performance shows that, right? We've been in this space for private credit since 2018 is when we first started it. And since then, we've been paying out steady dividends and quarterly returns to our investors, have not missed a single return or dividend payment to our investors since inception. So at least that goes to show that we have a consistent track record that we can.
so what you guys are doing at Loud. So I'm just gonna just kind of take a little deeper here. So at Loud, in terms of this private credit, it's more like you said, shorter term. People are looking for less than 5 year lockups for versus private equity. I've seen it where family offices are looking getting into like the 15 years. They rather have that stability of investing, to your point, growth, right? Looking at growth as the metric. And so it's fascinating to hear that families are looking more short term when it comes to this private credit. And to your point about not growth not being the primary goal here, and you kind of briefly touched upon it with the wealth transfer from one generation to the next generation. Is it a is it just a mechanism of that transfer process, or is the next generation looking at investments in a completely, totally different way than G1, the wealth creator, happened to look at it?
Yeah, so that's a good question because we've been talking to a lot of families that are either selling their businesses as they come into Gen 2. I think it's like 60+% of the companies sell in Gen 2. They typically sell off and they take the exit. And when operating companies sell, they want some type of steady cash flow. Is one portion of it. Gen 2 comes in, there's a little more longer term vision. That also has, they go into private equity, they go into venture. So that's kind of picking up again slowly as you look at the venture side. That's more of a longer term strategy, but they're looking for cash flowing type steady returns. So as they're diversifying their portfolio in the alternative market and looking at the different buckets that they would do in the public versus private, the private markets year over year, if you look at just the historical data and metrics over the last 50, 60, 70, even 70, 100 years, they've always outperformed the public markets. The private markets in general, from real estate, private equity, they have always outperformed. So why not put more allocation there, right? Still do public markets, but look at the private side and then diversify from the different buckets, whether it be real estate, private equity, hedge funds, venture, private credit, and have a nice diverse portfolio. We offer 2, 3 of them that we play in, not all, but find the right partners, right? Get to the right managers that are managing and that have that same value in terms of how we operate and having that alignment between what the family's looking for from their perspective, whether it be returns, impact, control, cash flow, and then blend that across different managers where they want to play. So what happens is when you look at a Gen 1 family, they started a business or a company, a service, a product, or maybe real estate portfolio, whatever they may be, in one specific domain. They are very good at that one domain. They got so specialized, so detailed that they got deep and they made great wealth for the entire family. That doesn't mean they know everything, right? Whether ego kicks in or whatever that kicks in. So that's when either you need to find another family that has another domain and something else that you can partner and be hip and hip with, because you want to bring people around you that provide value to you and something that you don't know, that you can have people in your circle. So other families should be working with other families in different domains so they can get access into other types of investment opportunities and have another expert next to them on their side that they can bounce ideas off of, or go or join a multifamily, right? And then multifamilies provide that when there's 4, 5, 7, or 10 families together combining their wealth, and you have a good back office group providing diligence. And then the Gen 2 side comes in, and now they're looking for a different strategy. Like, hey, we might sell the company off. The operating company sells off. So now we do want to look at other opportunities. The Gen 2 might have a different expertise in domain. Maybe they didn't work much at the company, right? So each family has a different dynamic as what we come across and where they want to allocate their wealth and diversify. So as a takeaway for us on that specific topic, we always think about finding the right marriage between the families and their values and what they're looking for, their strategy, and then coming back and saying, here, these are 2 things we do great at Loud. And if you're looking for something else, let us know what you're looking for. We have a huge network of other partners that we keep next to us because we're not an expert in everything either. And, put the egos aside and say, hey, let me help you move your money to this manager because they're great at this specific vertical that we don't play in. And we've heard great things about them. You guys should do your diligence. So we do that a lot. And we share within just a group of people we network with to provide the right value.
No, that's awesome. So, is there any like misconceptions or challenges that you guys see out loud when families are starting to get into this space for the first time, right? Getting away from that 60-40 traditional split that maybe G1 had? Like, what are you guys seeing?
So if I look at, just take one thing at a time, private credit as an example. Oh, they might think it's too risky. Is it illiquid or not? Do we have to hold it for 5 years in our portfolio? Actually, that's a big misconception. I mean, our terms are 2 years and 3 years. We used to do a 1 year, but we've gotten rid of that. We need a little bit of time to provide better returns. Remember, the private markets always provide healthier returns than the public. To do that, we need a little bit of time lockup. Not 5 or not 10, but even, typically private equities in that 5 to 6 year or maybe 7 year period. 1 or 2 is great. And our 3-year offering pays 13% yearly returns on a quarterly basis. And we've been doing that since inception. Before COVID, during COVID, after COVID, it's been steady. When the rates went up, we didn't go up. When the rates dropped, we did not drop. Maybe a cut will come again. We're not going to drop. We are holding steady on our portfolio. So that's one misconception, that private credit might be too risky. On the risk side, or illiquid, on the risk side to private credit, all the deals that we do, just the way a bank does underwriting, and they put a lien on the company, they file a UCC, they back it with their assets. We do underwriting just like a bank. So our process is collecting the bank information, looking up their tax returns, understanding there's no lien on the taxes, federal or state. We file a UCC or lien on every company we fund to protect our investment with their assets, whether it be their receivables, their equipment, their real estate. 70% of our deals are first position lien. That means we have first rights of collecting what we're going to collect. So it's not as risky. It is not a liquid where I can just sell a portfolio or sell a stock tomorrow when the market drops. But with that comes a little bit of protection, right? With that comes a little bit more strategy, and with that comes higher returns. You're not going to look at that 7-8% overall. If you look at the S&P stock market, between 8 and 10% net, we're in the 13. For 13 to 15, you're going to get close to high teens, double-digit returns from the private side. The other,
Well, go ahead. That was, I was going to ask you, like, do you get into these deals with others, or you said you're a first position? Which, to me, if it's backed by hard assets that are sitting on a factory floor, then it's pretty safe.
yeah. And the other misconception is, like, they think alternatives, maybe it might be Gen 1 thing, and they look at real estate, that's one thing, and that's long term, right? Real estate has some depreciation, has some asset appreciation as well, components to it. But if you think about alternatives, they used to think about it as just return enhancements versus, this is not an income driving investment. This is not steady cash flow, passive income, no stability. So it just depends on how you define alternatives, what buckets you want to play in. and there's real assets tied to it. There's income generating type returns that you can get outside of real estate to help you diversify, preserve your capital, provide good cash flow, and then replace that with the 60/40 model, that old bond stuff you're doing. So, hey, maybe take less on bonds and move to private credit, which has also predictable distributions, right? That generate nice, steady returns on that. So, those are two misconceptions that I would say at a higher level.
Yeah. No, that's good to hear. And like, are people when they look at alternatives, they look at maybe a cash flow replacement, right? They're liquidating an
Yeah.
operating business. Like, talk a little bit about some tax efficient kind of programs, or how do we look at that? Because I think sometimes we misunderstand the net tax effect of some of these investments, and we always look at these things as on a nominal basis. But talk about some of the tax efficient programs you guys have.
Yeah. Um, so when you make returns, you want to do your best to kind of shelter the taxes and find the right ways to set up the structure. But you also look at the other way. When you make significant returns, sometimes you do have to pay taxes because you made significant income, right? So it's a good thing. At least you're making returns, you're making income, and you're paying the taxes. So we have a couple of different strategies. If you look at the venture side, it's kind of like private equity hold, right? You're holding for a longer term. There is long-term capital gains that you can shelter against, and then you can wait it out and then only pay the capital gains tax. On the private credit side, it is more ordinary income, much more faster returns. You're paying quarterly dividends out, but the dividends are higher. But a lot of our sophisticated investors have trusts set up, have other types of entities set up that they can fund through and manage the taxes and offset it, or offset the income with other things they have in their portfolio. All of our funds are registered, SEC registered. They are compliant, and we have self-directed IRA capability. So a lot of our investors, whether they're doing a gift, setting up an RIA or a Roth IRA for their next generation or themselves, or backdoor Roth, that they can go in and invest in any of our offerings through a third-party custodian and have it tax deferred, or post-tax if it's a backdoor Roth or a Roth that was set up very early on that's built up over time. So investors are allowed to do that, take advantage of the private credit side, venture side, and come in for whatever plan they pick, and they can come in through a self-directed IRA trust, which a lot of people, like the sophisticated folks, know that because they have strong wealth advisors and tax planning people that help them. But even a lot of high net worth individuals are not aware of a self-directed IRA, which is like really shocking. So they might have their money on Wells Fargo or Fidelity or Vanguard sitting somewhere with their old 401k, old IRAs that they had, or even a self-directed IRA sitting somewhere, or a SEP IRA that they might have had if they had their own company. But you can take any of those funds, move all of it, part of it, and create a self-directed IRA trust with a third-party custodian and invest it in any of the private markets that are approved, that are held by a third-party custodian, and have the same tax strategy. And the returns are higher than the public markets. But Fidelity, Wells Fargo, Raymond James, whoever they're not saying that. They don't even share that with the client because the money needs to stay on their platform. They can't sell away. And I understand that. But I feel like it's in the right for the investor to know. And how do we educate family offices, high net worth, ultra high? Hey, these are other strategies that you could invest in, and then look at unique type of, call it, whether it be alpha returns, unique type of managers like us, that we're a boutique firm, right? We're not a 1-800 number. You call me on my cell, and our 500, 600 LPs will get a hold of me or any of my partners anytime. And that's how we operate, right? So we want to stay that niche kind of offering. Our structures are unique, our investment strategy is unique, and our returns are significantly higher than what you would see out there. And that's kind of the main strategy and how we operate as a firm with our investors.
And if people want to know more about those self-directed, just look up Peter Thiel $5 trillion or $5 billion Roth IRA, and I think you'll learn pretty quickly that there's a lot you can do within those tax-deferred vehicles. So help me understand, and the audience understand, the process that Loud specifically does when they're going through and seeing this deal flow. Like, where is this being sourced from? Are you guys part of this network where, let's say I'm starting a business, or I have a legacy business that I need capital, and
Yeah.
looking for private capital, well, not private, but debt. What's that mechanism? How does that work? So, from an investor standpoint, we have confidence that there is a process that you at Loud are going through that I feel comfortable allocating dollars to you guys.
Yeah. So, like I think I mentioned earlier, there's about 34 million small businesses across the U.S. And that's a huge network across all 50 states where we play in. So there's a huge broker network that supports those small medium businesses. So if I look at the private credit market, and then I'll get to how the deals come into our pipeline, it's about a 1.5 to 1 trillion dollar market. This mezz debt, senior secured debt, different aspects of venture debt. And then there's specialty finance. Specialty finance is probably about $140 billion space within private credit in the US. And then within that, we play in that market called revenue-based financing. And what revenue-based financing is, it's really providing capital based on future receipts and revenues and receivables coming in from the company, that we have access to those revenues and receivables for the future based on what we're going to fund you today. So we're getting it at a discount. Here's some money up front, and then we're going to make sure that as your revenues come in and your receivables come in, that we have access to those receivables across all the receivables in the company, that we can collect on those at a portion of it to help service our offering and our debt and the money we lent. So to service these 34 million companies, you got to have people boots on the ground. So we do a lot of organic lead gen, a lot of educational activity on the front end of our merchant servicing arm, where we're looking for the leads. So about 20 to 25% of our company leads come in organically. The other portion of it comes through this large broker network that are boots on the ground, working in their state, in their county, in their township, at the small medium business council, and really working with all types of different companies and industries to see if they want funding. Because of that whole $140 billion specialty finance arm, within that, if you look at the banking market, there's about close to the same amount of 120 to 140 billion dollars for these 34 million small businesses that cannot get bank funding, right? They're underbanked, underserved. We've been tracking since 2018, since we started this fund, up till now, till last year, we're getting our 2024 numbers, but year over year, large banks, medium banks, regional banks, community banks, credit unions are all dropping their application approval percentage year over year. That means by the time they go through underwriting, which typically for them to finish a whole case, it might take 45 to 60 days to do a true bank underwriting, they might not even make it all the way and might get rejected. And a company can't wait that long for funding. So they're looking for these other brokers and people out there where they can get kind of flexible capital to help them serve their business and their needs, instead of giving up equity and really growing the company. So this unbanked market is huge, and it's growing because banks are just getting tighter and tighter where they can fund. And then we're getting access to these companies through a broker network and through our organic lead gen. And they come into our funnel. We go through a full underwriting process. It's very, very thorough, very diligent. As I mentioned, just like how a traditional bank would do it, but we're much more efficient. We're using technology, and there's no red tape around us. Banks have other things that they have to go and comply against. And there's just so much bureaucracy and so much waste in the system that we can fund within 5 days or less. So our average funding is 3 to 5 days, and we're writing a check between 150, 200,000 all the way up to $3 million or $4 million. That's kind of our sweet spot of when we're lending. So that's kind of how we operate in our market. And then we're looking across all industries. There's some industries we don't like to play in, but a lot of them are professional services, HVAC, plumbing, construction, logistics companies, staffing agencies. We do some real estate, some restaurants as well that we'll look at. Depends on how large the restaurants are, how much transactions are coming in. So most of our companies are B2B that we play in. We do some B2C, like a restaurant would be a B2C. That is some part of our portfolio. But a lot of it's B2B, where their customers are businesses. They have steady cash flows of receivables coming in, large long-term contracts that are keeping the company afloat, that we can lend to a certain point. The remaining amount of their cash flows is used for operations, and the rest is used for servicing their debt, whether it be us or a bank or whatever that may be.
No, it's fairly well, first of all, 3 to 5 days. That is unheard of. That's
Yeah.
crazy. Um, but what's even more fascinating, you said that the banks are it's the amount that they're financing, right, is getting smaller and smaller. And is that, in your opinion, more from a regulatory perspective? Is there something else that, from the entrepreneur side now, let's go back to that side of the ledger, that they should be thinking about? Is it the criteria getting more difficult, more bars and more hoops to jump through? What is it that's causing these banks to shy away from this market?
Yeah. So what we're seeing is it's a little bit of both. You mentioned a couple points there. The banks, I think their box is getting tighter, or maybe they're keeping the box the same, but the company profiles are changing, right? Dynamics have changed. I think a lot of also things affected, COVID, the PPP loans coming in. There's an inflow of government capital coming in for that 8 to 12 month period when the whole kind of world was shut down for a little bit. So the companies' profiles have changed based on how they operated, coming into COVID, after COVID, the last 4 years. And I don't know if banks have adopted to that. So banks are still taking too long, right? So the speed becomes a new IP. That's kind of like what my thought is. Like, speed is a new IP. You have to move faster in today's market. Uh, you don't need intellectual property. By the time you go and implement something 60 days later, 190 days, 100 days later, the next innovation's already happened, right?
Yeah.
So why are we taking too long? Whether in the same thing of funding, the cycle of funding, just the process of funding. I just look at from my background's in Lean and Six Sigma, and I look at just from a
Mhm.
process perspective and a statistical. How do you cut that waste down? How do you be more efficient? Whether it be funding a company, whether it be evaluating a company, or even doing any type of other innovation. So I don't think banks have been able to move that fast, which the private credit market opened up, and a lot of wealth has come into that space over the last several years that is growing, and it's going to continue to grow. And I think these companies are looking for flexible capital that the banks can't serve. I don't want to give up equity, too much, red tape on the application process that banks can say, hey, we're going to take 60 days. They come to us, we're here in 72 hours or 36 hours. We've now written them a check and they're up and running and they can keep their business going.
And are LPs like concerned about the 3 to 5 days? Like that's we have this mind shift now where it's like we have this legacy archaic model that, like, just refinancing a house sometimes takes 6 months, and it's like, why? Yeah, it's either yes or no, and it should be pretty quick. Is there any concern that the LPs are like, oh, that's pretty fast, we don't know, but is it just the frequency of your reporting, your performance shows like, hey, our model works? Like, what is there an issue with that?
So it actually is very surprising when we talk to a lot of LPs and new family offices that get introduced to us in our network, and they're like, "How do you operate like this? How can you fund this many companies? And then we show them the metrics. We show them how many companies are out there that get funded. How big is our market? It's around $40 billion of new money coming into our space, our niche space that we're in, and we're probably in the top funder. There's a good amount. There's a fragmented market, and that's not the amount of origination of deals happening. The origination deals probably double that because our deals are much more shorter term. We're in that call it 1 year or less. So the amount of deals happening are probably double. So it's probably $80 billion origination space and growing. When they understand that how big this market is and how many small medium businesses there are, how many people they employ at a just national level, you take it at a macro and then work your way down. And here's how the deals operate and how many deals we see a day, and we show them everything. I think that the light bulb then goes off. That I was surprised that this market even existed. That this investment strategy has a potential of generating very high yields and returns on our two different offerings that we have for private credit today. So it's an eye opener and it's an educational experience for them as they kind of learn more about the space. And once they get comfortable, the beauty about our offering, there's two offerings. One is you come in, pick your 3 year term, and you get paid out every quarter. You come in today, 90 days from now, your first dividend gets paid out. So they see their money work. They see their dividends come back. They see our reporting process, our cadence. They get comfortable, and then they keep adding on more. because they can see access to how we operate on the deals, what we're doing, which deals are in trouble. Because you remember, deals do go in trouble when we're lending. There are issues with that, and we manage our cash accordingly. And then our other strategies is in the same investments that we're doing, but we're sharing the profits on the back end because there's a significant amount of returns that we can do. So 13% fixed, come in for that. Once you feel comfortable, add on more. Once you learn about our space and how we operate as a firm. And then the other portion is, you call it a 4+1 strategy. You come in for almost 5-year capital commitment, but we're sharing the profits on the back end, right? So the net returns are split 80-20, and the return to the investor are in the 22 to 24% net IRR. So you can come in for 4+1, 5-year at a 22%, 24% net IRR, or come in for 13%. Pick where you want to come in, same strategy, but just a different time horizon, right? So we've given that flexibility to investors to pick where they want to come in based on what they feel comfortable with.
Let's stick with that model. It's interesting. So where is that how's that opportunity for a rev share be created? If someone's paying you, if you're lending a business money and they're paying you back interest and principal, where is that 80-20 split? Like, what happens? What's that mechanism? Is there a warrant? Is there other things that are part of a lot of your strategy that makes you guys different?
Yeah, so the way we invest, since we're doing 3 to 5 deals a day, we are investing in a lot of deals. So the volume of deals is very high, right? So we're deploying the money pretty quickly. We're also collecting the money very quickly. So what happens for the first 4 years of that other strategy that we were kicking off the fund is investors commit, they get a nice steady coupon, a semi-annual coupon in the 8% range. So you still get something for your money. You're getting a nice 8%, which is almost kind of what the market's doing right now if you normalize it. And then you have to hold for 4 years. So in that 4-year period, what we're doing is we are investing, reinvesting, investing, reinvesting, because we're collecting from hundreds of companies every day on a weekly basis or daily basis. Because every day we have cash flows coming back in. Because we have 20 companies we're collecting from them on a Monday, another 20 we're collecting on a Tuesday, another 50 we're collecting on a Wednesday. So by Thursday or Friday, I have hundreds of thousands of dollars sitting in my bank of next cash flow that I can invest to the 101st company, then the 102nd. So now the churn of money starts happening. So as we're doing that for the first 4 years, we're redeploying capital, and also fresh capital came in, right? The first maybe year as we raised our money. And then you just wait until year 4 hits. You get a coupon. At the end of year 4, we stop reinvesting everything. And we just sit there, and now we're collecting on all of our investments out there that we've lent on. Principal and interest, everything combined. But we've already flipped the money multiple times, right? So that allows our investors to sit there, and on year 5, we just sit there and collect as they get their principal paid back, the investor's original principal. Thereafter, the profits are split 80-20. So that's how
Thanks
we
for
set
explaining
the
that.
model.
Yeah, makes sense. Is there ever a room for a perpetual fund that just, people can sit around for 10 years and get out that whenever they want? Or is that a nightmare for you guys? Because it seems to me that the model you guys have makes sense just to leave your money and let it just continue to work for you.
Yeah, so our evergreen fund, the 2 and 3-year option, is a evergreen offering. It's been around since 18. It's not closed ended. Anyone can come in and out as they please. When your 2-year or your 3-year term expires, you can renew, you can liquidate, you can reinvest it back with your dividends you got paid, because we pay out every quarter. That's what a lot of investors do, especially in their self-directed IRA, and then they can put it back in. So that's been around. That's not going anywhere. It's turned into such a large investment, and our investors like that flexibility. Hey, 2 years, 3 years, pick your option, and then renew whenever you want. So that's kind of like a never-ending, offering that's going to be around for a while. I think our investors like it a lot, and then they feel comfortable, then they jump into some additional investments with us.
And then, so on the LP side, back to that side again, are you having conversations with the principals of the family offices, the family office employees, the people that support the families? Like, who are you talking to? Because it seems to me like this is a great way of, again, diversifying your investments, like the cash flow, or if it's tax strategy. and looking at maybe allocating more than what the traditional allocation of percentages would be to alternative investments. But who are you talking to in these offices, and how are those conversations going?
Yeah, so it's been a mix with multifamily offices. We're talking to the main partners running the multifamilies because a lot of it's at their discretion of them deploying capital on behalf of multiple families. At the single family office level, it's a combination of both. We're talking to the CIO or maybe the matriarch, the patriarch directly themselves that we've had conversations with, of them making the decision on where they want to deploy their money and getting to know us. Right, it's more of a relationship thing at the single family office level, getting to really get to know them, spend some time with them, understand that there's a value alignment in terms of what they're looking for and the type of manager they want to really kind of invest in and support. So at the single family office level, we spend a lot of time just getting to meet the entire family themselves, the family office team. Or a lot of the folks that they're medium sized or smaller family office, they don't have a big team, right? They're just the families themselves, and they might outsource certain activities or might be reach out to other managers that they like, and they rely on the managers to really take over that domain that they want to invest in. So it's more of that. And then for larger families, we're talking to the analyst or the principal or somebody in the investment committee that does the first look. And then eventually you still get to meet the family, which is great because families want to know what's going on, where their funds are going, where their capital is being deployed, and who's really managing it, right? So for us, really maintaining that relationship is important.
And what are you seeing in terms of um, percentage of assets allocated to this sector? You know, you again the 60/40. If we go back to that model, like how much has traditionally been allocated to the alternative investments arena, and now are you seeing that shift as we're going through this change in generational change of legacy planning?
Yeah. So what's interesting, we were just reading some articles. There's a KKR and then BlackRock. A bunch of them put out some articles last couple of years of how capital and wealth, whether it be family office wealth, high net worth wealth, it used to be that 60/40 was there. That's now boring. And then maybe 20% was coming into alternatives. And now it's almost a 50-50 split. Public markets 50% or even a 60/40, where it's 60% alternatives, 40% public markets. And when I say alternatives, I put everything into that, right? Real estate, I would say real estate, private equity, venture, private credit, hedge fund, commodities hedge fund in that space, and other types of, I would call it mineral, I call it oil and gas, kind of natural resources. That would be the next bucket of alternatives. If you combine all that, that's kind of what you would see the alternative market as. So they're kind of really 50-50, 40-60, where 40 being public markets and 60 being alternative private. A lot of money is moving to the private side, and that's what just all the reports we've been seeing from UBS and KKR, that a lot of large families are moving their money that way, which is great.
Yeah, no, it's great for you, right? Allowed
Yeah.
for sure. So just to piggyback off that, so what's the next 5, 10 years look like in terms of this space? Like, what are you anticipating to happen?
Yes, I would say over the next 5-10 years, like I said, like alternatives are going to grow. The small medium business market's going to keep growing. I think just look at the U.S. economy and having private companies that employ 45-50% of all workforce. That's going to keep growing. Not that many companies go public. People think a lot of companies go public. Actually, look at the number of companies that are out there in the U.S. Oh, I think it was like 1 or 2% truly go public. So everything will be maintained on the private side, and it's going to keep growing. Capital is going to keep coming in to the private markets over the next 5 years. I say 2035, 2030, 35 over the next 5 to 10 years, I would say. Uh, there's going to be I would say a shift in terms of which buckets they come into. Will real estate kind of come down and go through a cycle? I think venture is also going to come through its cycle now. It went through a kind of a death spiral on venture overall, just as a market. And this is probably a good time to get in and start your vintage. Like when you create your vintage of your portfolio, this is a great time to come in because a lot of valuations dropped over the last couple of years. A lot of companies did down rounds, and then they were looking to raise. And this is a good time to really come in and build that venture portfolio. And then private credit is going mainstream, right? Private credit, that term private credit was not around even when we got into this. Like people just call it specialty finance, asset-based lending. It was all kinds of different names. And this is in 2016, 17 when we were first getting our fund going. And then private credit just took off. Really after COVID, it just got so much popularity that everyone, anywhere you go, any website you go on, any wealth management, private credit, it's kind of like been bastardized in some ways. And then people need to understand there are so many segments of private credit. We only play in one small portion of that $1.7 trillion market. We're like 130 billion, and of that, we're a niche within that as well. A lot of different segments within private credit. So, but specializing it and really knowing the niche type of markets in private credit, you can do mezz debt, senior secured debt, get a nice steady dividend. Sure. If you want a little more alpha generating, type investments niche, that's where we come in, right? That's our edge of how we play in the market. And we see that continue to grow over the next 5 to 10 years. And then I think from a structure standpoint,
Mhm.
I see just different types of deal structures. Family offices are looking for like this bespoke investment strategy. They want to have a little more customization, co-investment strategies, shorter term durations, where they have more transparency, but also ability to kind of create unique structures because there's a lot of wealth. That wealth shift that's happening, they're going to have that opportunity to come in and be able to customize and have a little more flexibility on that structure. And that's what I see over the next, 5, 10 years.
No, definitely makes sense. Yeah, it's a like I would say like the connotation you hear from private debt is like the loan sharks, right? You're getting, double digit interest rates, and that's not necessarily what's happening, right? You're taking this traditional model of banking and just doing it more efficient, and so you can be competitive on the
Yeah.
rates that you're charging these individuals. And so, do you guys what I've seen in the families, almost families go into like I would say two different directions when there's a generational shift from one to the other, where some go into this passive, let's sell the operating business, let's go to be an ETF type of family and just kind of be more of an accounting function. Then there's this other side that is sticking to growing and acquiring businesses. And so do you get involved with the M&A piece of operating businesses that are looking for really good capital that is aligned with their mission and saying that we see, yes, we want to do our own kind of private equity venture deal where we're buying up these companies that are going to vertically integrate our business and make us more efficient, more agile. And then we have fun. We're growing as a family because we're at. Do you get into that space? Do you help with that?
Yeah, kind of like almost like a business development kind of buy side, sell side type thing. It comes up a lot. We are working with a few families and taking that role as we have access to so much deal flow and certain type of companies. So if you look at the lending side, we see so many deals in different industries, right? That might fit the box of a family that wants to acquire a business in a specific industry or state or maybe an adjacent market that they want to come into. So we help with that. They're looking to expand. They have a lot of cash flow. They might have sold a business and they have money that they want to go and deploy and acquire another business and maybe not take control or maybe not maybe take operating control, but not management control. Let the management team stay in place and continue growing the business, but moving their capital somewhere else into another company. So we do help with that. We see companies that come across our table that might be the right fit for our clients that we can push that along. So we play that role, but not in an official manner. We're not being hired to really just do that. That kind of naturally happens just over time as in terms of how we operate. But our main focus has been, we're going to invest in private credit in our specialty finance lending arm. We're going to drive our underwriting and invest in and provide returns. And along the side, something comes about that happens, or we have people in our network that can support that as well.
Yeah. No, I agree. It's like if it comes to fruition, great. If it doesn't, that doesn't, take away from what you guys do every day. So what else about Loud do you want people that are listening here to learn and take away from this conversation?
Yeah, I would just say take your time, get to know the alternative market as investors come in. Whether even if it doesn't have to be a family, a high net worth individual, anybody who can invest and come outside of the public, side of things and move to the private side and explore that. Right, do your diligence, learn more. Go a little deeper. Start small. It's okay. Find managers that you can start small with that have the flexibility. We provide that. Our minimums are lower so people can get their feet wet because they can definitely afford it in investing, but they might not want to go into these niche markets. They might not know us as well. And for us, we don't do any solicitation, right? We don't go out there and send spam emails out to a bunch of families. We are organically grown through just relationships and through referrals. That's how people have gotten to know Loud Capital and how we operate. And our performance shows for it now. So start small, go deep, get in a relationship with a manager that you like, that you can really explore the alternative market that provides that flexibility, and then you can get into it and then learn more and then build your overall portfolio, right? Through the alternative space. That's kind of like one main thing I would take away, because there's a lot of room for opportunity and a lot of room for getting strong returns in the private markets in general, and just find the right kind of person you want to do that with. That's kind of our takeaway.
Yeah, good. And then I have to ask this. Has there been a company that's come across your desk that you guys have invested in that's like, wow, I never knew these things existed. This niche company. Is there any that you can share? Any fun stories of ones that, without giving too much detail, of because I'm always amazed how many businesses, to your point, how many small businesses are out there, and you don't know about them because they're just not mainstream. Any ones that come to mind as like a fun one that you worked on?
Yeah, I mean, probably maybe people probably consider it boring because like, the fun ones are always in venture. Venture has these cool technology, cool companies. Like, oh my god, it's an awesome idea. We have a hydrogen fuel cell company, by the way, called Hyperion. You can check it out. They have an amazing car. It goes over 1,000 miles in one charge. The byproduct of hydrogen is water vapor.
Mhm.
So XP1 is their car. They've been on Supercar Blondie, on the Jay Leno car show. Just look up Hyperion Motors and you'll see them. I'm on the board there. So we were early on investors in Hyperion. Really amazing company, their technology and what they're doing. That's the venture side. That sounds really exciting and sexy. Like, oh my god, you look at the car, it is badass. Then you go the non exciting side, which is the boring, the small medium businesses. I mean, one company that we funded was a meat packing company. Like, who would want to fund a meat packing company, right? But this happened coming through COVID. During COVID
Mhm.
time, everybody was looking for packaged meats, right? Because
Mhm.
grocery store, you couldn't go to the grocery store. You need to keep food that's a little more, longer term in the house, and packaged meats and stuff, whatever you can get, deli meat, and they couldn't keep up with the order. So there's a company that we funded, and their customers were Kroger and and Lord Meyer, and their terms for their payments are 100 days, 120 days. So they don't get paid from these big, but we know Meyer's going to pay, Kroger's going to pay, just a lot later. But these companies need an inventory. They had to keep their machines running to provide packaged meats. And it was like completely non-sexy than Hyperion, which is like a hydrogen fuel cell technology company. So
Yeah.
we're funding the other extreme of it, and we're coming in finding these unique companies that need capital
Yeah.
and keeping them going. And we were able to service them between their ARAP gap and provide the capital needed for them to continue expanding and getting product out there. So we come across unique deals on both spectrums that you can say on how we operate.
Yeah, back in my public accounting days, was a fortunate. I'm a tax guy, but fortunately had an opportunity to do some Sarbanes-Oxley work and did a lot of factory tours. And it just amazes me what kind of I love manufacturing, just loving these machines and seeing how these things come together and what they produce. But what other what personal? Let's go to the personal side. What other non-sexy things do you work on that are near and dear to your heart that you want people to know more about?
Yeah, so I am big into music. I consider it my professional hobby. I grew up playing the Indian percussion drums called tablas. My mom's a classical singer. My grandfather, my great grandfather. Music's been in my family for almost 5 generations. So I used to own a record studio and a record label back in Detroit with all my college buddies. Did a lot of production work. So I'm big into music. So I am passionately still performing for world music festivals, jazz festivals here in Chicago whenever I can. I'm on the board of trustees at Merit School of Music, which is a very large nonprofit down in the West Loop. We put about 3,000 kids through the music education program in the Chicago public school area, servicing about 130 plus zip codes. So when the first thing they cut, when they cut the budget in the Chicago public schools, they cut arts and music. And we bus kids around all the way into Merit in the West Loop, and everything's tuition free. Music instruments are free. 300 kids go through a top conservatory program that are very gifted and talented. And about 98% of our kids eventually get a scholarship or some kind of financial aid or something through music, a scholarship into getting into college. and they might not take music as a program when they graduate and go from high school to college, but they still have a scholarship to get into college and go somewhere. So it's a great program. I've been on the board or been involved since 2015. Actually, that's almost 10 years.
Wow. Well, that's
Yeah.
definitely fun. One of the families I used to work for, big into the Chicago um, arts, and that was one of the organizations that they completely supported. And
Yeah.
great organization, great leadership there. And so, um, but anything else before we part ways here that that you wanna share, or again, any last minute um, m- comment about Loud? And again, I agree with you. When I look at families and advise families, we talk about trust, and um, it's more important today in being authentic and trusting people. That's something that I don't think AI would ever replace. And so I appreciate when you say that. I agree that when people take that first step, just take a step, take a leap of faith, and build that trust. And so
Yeah.
sounds like Loud definitely takes it to heart.
Yeah, no, we love it. I think just our backing of investor support has been great. Uh, it's continuing to grow. I think people see how we operate. We're very transparent. We're just like a niche group of folks you can get a hold of anytime. I feel like we have this. All of us are entrepreneurs. All of us managing partners have started our own companies, have sold off. Some have been great. Some have not. That's the experience of being an entrepreneur. But we have this venture or this entrepreneur DNA, and then we have this credit discipline, right? Credit being like very box structured. I'm a data guy, engineer, so you balance those two. So you're always looking at from a lens of seeking opportunity, going after things, and being entrepreneurial and innovative. But what's the downside protection? There, credit comes in. We have a structured process on how we underwrite and drive that. So we're balancing that with our two offerings, and then we can scale it. Right, we're scaling it. We're repeatable, and we're providing that yield that investors can get over a long period of time. So, yeah, it's kind of mentioned one thing to take away. Just reach out to us, and I appreciate you having me on your podcast and spreading the word. And anything I can do to connect with other people in the network and spread the word on alternatives, always here to do that and support.
Definitely something that when I first got into the space didn't know much about, and as I spent more time, it's definitely ever evolving. And so I'm glad you're able to jump on. And again, Nishad, appreciate it. Thank you very much. And then in terms of Loud Capital and the Chicago Merit School, I will definitely put those in the description. So if people would
Please.
like to take a look at that, feel free to do that. So Nishad, hey, have a great day, man.
Thank you. Thanks for having me.